The March contract, which goes off the board on the 27th, there was 47,847 contracts representing 239 million ounces of silver. There was 400 million a week ago. We are 4 days away from delivery with 239 million ounces in open interest outstanding as of yesterday. But there's only 88 million ounces in registered silver. Where's there a problem here?
It will wipe out everything that's in COMX.
And so got silver right now.
Oh, it's
flat. It's at 88 bucks. 38 million shares were entered at pretty damn close to the bottom. How was a share issued? Share is issued when one of the authorized participants, JP Morgan, Goldman Sachs, Citi, deposits the silver. So they sell it at 110 bucks. Bang, they knock the hell out of it and deliver 38 million shares at 60 bucks. How does that work? You have it inside of SLV in controlled institutional vaults. Share redemption. We've seen something in February that I don't know that we've ever seen before, which I'll explain in a moment, but I want it to be very well understood that the volatility that we've seen, the corrections that we've seen, were induced largely by margin increases that shook out all of the speculators. And you can see the open interest that has collapsed. A lot of the open interest rolls forward to the May contract in silver, but a lot of the open interest fell out of the trees when the big money shook the bushes, raised the level of margin requirements by 300% to the point where a lot of good businesses got, I think, clobbered, like refineries. Mm-hmm. This is something that I think they probably got a lot of shit for, in the respect that raising margins to these levels crippled part of the economy, and all of the refiners who got margin called on all of the metal that they had in working production, they hadn't even broken it down yet, and they were getting margin call after margin call after margin call. I don't look at this as something that we will see on a repetitive basis. I look at this as a one-off to get a lot of offsides players on sides, that being the banks in the United States. But here's a really interesting thing. And I just want to simply say, if we were to say one thing and drop the mic and be done with this podcast, it is simply this, and pardon my profanity, the people who have been bringing in 9 figures a month, every month since a year ago, November, do not fuck around.
February's volatility wasn't market-driven. It was engineered by margin spikes. As Andy Schectman notes, raising margin requirements by 300% forced speculators and even legitimate businesses like refineries out of the market. Open interest collapsed, with a portion rolling to May, but the bulk simply vanished. This is a one-off intervention, not a recurring pattern, designed to shift leverage toward well-capitalized players. For investors, this signals risk for anyone using borrowed capital, as systemic moves can instantly wipe out positions. The broader takeaway: liquidity events often disguise who actually controls the market. Next, Andy Schectman exposes who consistently profits while others get shaken out of silver positions.
Wayne Gretzky always used to say, "I don't skate to the puck, I skate to where the puck is going." People who are spending billions and billions and billions and billions and billions and billions, and I can keep on going, every month with zero media coverage. And that's not a coincidence either. They know where the puck is going. They don't do these things unless they have every intention of receiving a commensurate return on the risk that would be imposed by posting billions of dollars. Now, here's another interesting thing.
Before you go, I got to tell you, love the Gretzky analogy.
That's true.
I mean, love it.
Thank you.
Love it.
It's true.
It's great.
I know, but it's great. It's true, though, because that's what these people do. The people at that level are armed with the most valuable asset in investing, and it's not money, it's information.
Yep.
And if it, you remember the second Back to the Future, the guy had the sports almanac, right? Yep. And he made gazillions of dollars betting because he knew where the puck was 100%. Going. And this is exactly what we see here. And it's the same thing we saw in 2017, 18, and 19 when I was doing a lot of public speaking. No YouTubes at that point, but I was talking publicly about the amount. Why is the German Bundesbank making such a big deal about standing for delivery after 6 years in a row of the price falling from 2011 to 17?
Billions flow quietly, far from media scrutiny, And that's exactly where informed insiders position themselves. Andy Schectman emphasizes that these actors aren't gambling. They're leveraging top-tier intelligence to anticipate shifts. Historical trends from 2017 to 2019 show similar stealth accumulation, with central banks like Germany suddenly asserting delivery rights after years of price decline. For investors, the lesson is that headline volatility often masks where real money is moving, and failing to account for institutional foresight can make retail moves counterproductive. Insider strategy drives the real puck, not price chatter. Up next, Andy Schectman details how central banks and institutions orchestrate physical gold and silver flows unseen by markets.
And then right after that happened, the Bank of Austria, Hungary, Turkey, Poland, the Czech National Bank, the Dutch National Bank, the Bank of Austria, they all said, yes, give us our gold back too, because remember, the Fed, the New York Fed, held everyone's gold for 50 years because it gave direct access to the COMX with New York, with Western rule of law, safe jurisdiction, no risk. Yeah, of course, you can hold it for us, and if we need to trade it or sell it or move it, we can move it to the COMX. But why are they all wanting it back right now? Then it became the next year, 2018. Those same banks bought more gold as a group than they did in the 60 years previously combined. And then the next year, that number doubled. And it was complete and total coincidence, of course, that the BIS then said, by the way, in 2019, gold is now tier one. Really? They didn't know about this in 2017 or 2016. So let's look at what we see happening here. And this is not talking about gold, which I believe is the exact same thing, but different. But silver, for 16 months in a row, between 40 and 70 million ounces of silver have been delivered every month. Every month. Now think about this for a minute.
Central banks suddenly demanding physical repatriation signals, strategic repositioning. Not coincidence. Andy Schectman highlights that Austria, Hungary, Turkey, Poland, the Czech Republic, and the Netherlands collectively accelerated gold purchases in 2018 to 2019 far beyond prior decades. Silver exhibits parallel behavior, with 40 to 70 million ounces delivered monthly for 16 straight months. For investors, this indicates that behind-the-scenes accumulation is reshaping market dynamics, and supply pressure may be understated by conventional reporting. Ignoring physical flows risks misjudging exposure to metals. Next, Andy Schectman drills into just how massive these silver deliveries are and who's moving them.
Mint box of Silver Eagles is 500 ounces, weighs 42 pounds. Who takes possession of 70 million ounces of silver? How many trucks does it take to load that up, and where are they going? Every single month unabated, including non-delivery months. And ask yourself, why does no one talk about this? The media talks about the price and that it's overbought and that is it 2011 again? Is it 1980? All the shit to make you think you made the wrong decision. They miss everything. The only question that should be asked is, who's doing this? This has never happened before. Sure, there are deliveries. Not like this, not massive deliveries, usually less than 1%. But here's another one for you. So for the February contract, which ends in 2 days, right? 3 days, on the 26th, the February contract, the way it normally works is that those who are holding contracts that are going to stand for delivery, the very first day that it posts, which would be the last day of business in January, they would say we're standing for delivery. But throughout the entire month, you can buy an immediate contract and stand for delivery. Now, here's what's really interesting. Check this out. You might even want to write this down. The February deliveries for COMX, 4,639 contracts so far. That equals 23,195,000 ounces. A lot of silver that was delivered from wherever, London, Switzerland, wherever the hell it came from. It was delivered instead of rolling forward or cash settling.
Deliveries of 70 million ounces monthly are orders of magnitude beyond normal patterns, yet media coverage ignores it. Andy Schectman points out that historically less than 1% of contracts stand for delivery, but February saw massive participation. These flows suggest opaque accumulation by institutional players, potentially central banks or high net worth entities, controlling physical supply. For investors, it's critical to understand that reported spot prices may underrepresent real demand and scarcity. The infrastructure needed, thousands of trucks and logistical coordination, makes this a deliberate, large-scale operation, not retail buying noise. Coming up, Andy Schectman quantifies the total exodus from COMX and its implications for market stability.
Remember, only 1% used to stand for delivery. The majority of the contracts that have posted in February are standing for delivery, not 1%, a hell of a lot more. Okay, that's a lot, 23,195,000. Not as much as we've seen in previous months because February is not a primary delivery month. January is, March is, May is. So, but here's the interesting thing. 23,195,000 stood for delivery so far, but 38,082,934 ounces have left COMEX. Left it. Where the hell did it go? Who took it? How many trucks does it take to take 38,082,000 ounces and drive it away? How many semis and to where? And why is no one asking? So if nothing else was understood tonight, if nothing else was understood, period, in the light of a market that got its ass kicked in 2 days in a manner that was so contrived it's pathetic, who is spending this kind of money? And these people, 38 million ounces times $80 an ounce, do the math yourself, you're what? Almost $3 billion, right? Who is doing that? Now, is it any coincidence, just like the BIS reclassified gold tier 1, after all these banks repatriated and then went on an incredibly large buying spree, way outside the realm of what was normal, is there any coincidence that for 15, 16 straight months it's been happening this way here? And it must be a coincidence that silver has now been classified critical mineral and that the government is putting price floors underneath it and they're going to accumulate a strategic stockpile.
February's delivery patterns are off the historical charts, signaling deliberate accumulation by large players. Andy Schectman points out that while historically only 1% of contracts stood for delivery, February saw the majority, totaling 23,195 contracts, with 38.8 million ounces leaving COMEX. That's nearly $3 billion in physical silver moving under the radar. Investors need to recognize this isn't retail-driven. It reflects strategic positioning ahead of government stockpiling and Tier 1 classifications. The scale of logistics alone, trucking tens of millions of ounces, underscores institutional orchestration. Next, Andy Schectman explains how margin adjustments manipulate price and funnel silver into controlled channels.
What you saw that happened when Kevin and I were away skiing, when the price collapsed, is one thing and one thing only. They jacked up the margin so high that all the people who are very well heeled, maybe even have $1 million or $2 million in their margin account, found out what happens when margin requirements go up exponentially. Enough to make everyone say, I give, and have no choice but post more margin or sell, which begets more selling, which begets more selling, which begets more selling. And what happened at the very, very bottom? JP Morgan covers almost 800 contracts. But how about this one? SLV, that massive ETF, which changed the prospectus in February of 2021 during Silver Squeeze, to say that there's a lag between the time that we accept your order and the shares are issued with silver backing it because it's coming in so fast. They did it on a Saturday night, that being BlackRock. Well, how about this one? 38 million shares were entered at pretty damn close to the bottom. How was a share issued? Share is issued when one of the authorized participants, JP Morgan, Goldman Sachs, Citi, deposits the silver. So they sell it at $110. Bang, they knock the hell out of it and deliver 38 million shares at $60. How does that work? But even more than that, now you have it inside of SLV in controlled institutional vaults where all these so-called authorized participants for the last 3 years have been doing what's called share redemption.
Extreme margin hikes in early 2021 weren't random. They systematically forced weaker players to sell, while consolidating silver into institutional hands. Andy Schectman highlights that JP Morgan, covering 800 contracts and 38 million SLV shares being issued, illustrates how ETFs can obscure physical flows. Investors relying on price signals alone may underestimate the real supply shift and the impact of authorized participant mechanics. The lesson is clear. Leverage can backfire quickly, and institutional coordination can fundamentally reshape perceived market liquidity, even when retail sentiment looks bullish. Next, Andy Schectman dives into how SLV and share redemption hide the true scale of physical silver accumulation.
Instead of taking delivery off of COMX, they put the silver into SLV and then redeem the shares in the form of physical silver. It's opaque, it's invisible, blah, blah, blah. The point of it is that I want you to all to understand as we continue to go through this tonight is that nothing has changed. And in fact, the deliveries, there's one more thing to mention about the deliveries. So that was February, right? Let's look at March, okay? The March contract, and now this was as of a day or so ago, which goes off the board on the 27th, I believe, okay? Yep. So as of the other day, there was 47,847 contracts representing 239 million ounces of silver. That was the open interest. That was the amount of contracts that are out there that could stand for delivery. This late in the cycle, remember, most stand for delivery the first day. The others, there was 400 million a week ago. So some fell off, some was forced off, some rolled into the May contract because that's the next primary delivery month. So 100 million ounces disappeared, right? We are 4 days away from delivery with 239 million ounces in open interest outstanding as of yesterday. I haven't looked at it today, but there's only 88 million ounces in registered silver. Where's there a problem here? 239 that think they could stand for delivery against 88 million in availability.
The discrepancy between open interest and registered silver is stark, 239 million ounces versus 88 million available. Andy Schectman's reporting shows that much of this is masked through SLV operations and rollovers, creating an opaque system where market signals mislead traders. For investors, this reveals systemic supply risk and the hidden influence of institutional participants, as apparent availability diverges sharply from reality. Ignoring these structural factors could leave portfolios exposed to sudden delivery squeezes or price dislocations. Up next, Andy Schectman explains why backwardation now changes the rules for anyone shorting silver.
So basically, if
it's almost
35% of the contracts stand for delivery, it will wipe out everything that's in COMX.
And so I'm not calling for a wipeout in COMX. That's not what I'm saying. But what happens, we see a market now that is in backwardation and has been for a while, meaning normally markets live in what's called contango. And that means today the spot price is less than the futures price because the futures price takes into account the time value of money, storage, interest, etc. The further out you go, the higher the price is. But now it's like saying, I don't really trust you or your promises, so I'll pay more for it right now, right? So if you short into a market in backwardation, you're an absolute fool. Like TD Bank figured out 3 weeks ago when they said silver's going to 40, put a huge short on, got stopped out at 92 in a market in backwardation. So the thing is simply this, that right now, there is a market where the demand for physical is far higher. And we've never, and I've for 4 years, I've been saying people are standing for delivery. It's never happened like this, but it's getting to the point right now where it's becoming obvious to the traders. Everyone always said, well, why not just buy all of it, dump all their money? And why doesn't China put $1 trillion and just clean it all up?
Backwardation reveals that spot demand for silver exceeds futures pricing, a clear signal that traders underestimate physical scarcity. Andy Schectman notes that shorts like TD Bank were crushed after betting on $40 silver, highlighting the risk of ignoring structural supply constraints. For investors, this implies that traditional contango-based models no longer reflect true market conditions, and physical accumulation is dictating price behavior. Recognizing backwardation is critical for hedging strategies and portfolio risk management, particularly as institutional players exploit it to consolidate positions away from retail eyes. Next, Andy Schectman examines why artificial limits and paper contracts can no longer hide real-world supply pressure.
Because the markets would poof, they'd blow up like a puff of smoke, and they would just shut down. Everything would get jammed up. Instead, they've cut us with a piece of paper every day for the last 5 years. We're bleeding out, but it's accelerating now.
Death by 1,000 people.
Now you can't put enough Band-Aids on the victim. Yeah. So all I'm simply saying to you is understand this, that they did this to mess with the speculators on COMX who figured, let's just take advantage of this run where in early December, $16,000 controlled 5,000 ounce contract. Now it's almost 50,000. It's gone up 3 times, 300%. And those margin increases force these players to sell and realize that no matter how well-heeled you think you are, you're not well-heeled enough to play in that sandbox. And the open interest has dropped into the hands of the big money who doesn't use margin to stand for delivery. And that big money always used to be the central banks, right? Now it's the biggest, most well-informed, right? Let's just say well-informed. Where is the puck going? Traders in the world, and those are the banks here in the United States, who have been told by this administration silver is worth more than the dollars that we are using to buy them. And all of you banks here in the United States, get on sides. And you can see that by the report by the Economic Times and the Commitment of Traders, who shows the banks in the United States are moving to net long. Like they need to get really long, not just net long where you're a little more long than short. That's what this was about. It's going to come back. And that's what we see right now. We're in the aftermarket. We got silver right now.
Oh, it's
flat. It's at $88, but it's been a strong. Which
the COMX margins and rolling open interest reveal a concentrated, well-informed player base, not random market fluctuations. Andy Schectman emphasizes that margin-induced selling transferred control from speculators to institutional entities, including US banks now going net long. Retail investors may see prices flat at $88, but the underlying dynamics are heavily skewed toward those with insight and capital. For portfolios, this highlights the risk of chasing apparent trends without understanding who really drives supply and delivery.